All right, everybody. Hopefully, you guys are finding your way into Tax Tuesday. If that's what you were looking for, you're in the right place. So let's let the room fill up. My name is Toby Mathis, and I'm joined by
Elliot Thomas.
And we are going to be your hosts today for another Tax Tuesday. We do this every other Tuesday, where we try to bring some tax knowledge to the masses. What's good today? First off, let's go over the rules. How many of you guys, this is your first Tax Tuesday? You've never been on Tax Tuesday before. Give me a thumbs up or some sort of emoji so I know it's your first time. Well, there's some.
Go on.
There's some more. Fantastic. So if it's your first time, welcome. We try to keep these fast and loose, and Elliot's really goofy. Me, I'm the straight. I just play it straight, everything. All right, let's talk about the rules since you're here for the first time. What you don't realize and what you don't see is that I have a whole crew answering questions while we're up here pontificating. We have Troy, Jeffrey, Patty, Kenny, Jared, Ross, Dutch, Tanya, Rachel, Arash, Amanda, all answering questions. We're talking tax attorneys, CPAs, accountants, etc., all here to answer your questions. All you got to do is go into the chat to ask a question. If you have a comment, like Sherry just said, hi, Patty, put it in the chat. You guys, I don't think you can see each other's chat just because there's always somebody who's a Nigerian prince asking for money or an insurance person who thinks that infinite banking is brand new. So we just try to keep them off of you guys. So you can go into the Q&A, though, and have a nice conversation with a tax professional, and the rest of the time you can put comments like, shut up, Toby. That always works. All right. Ask questions and the rest of the time, and Elliot gets these. If you email to Tax Tuesday at Anderson Advisors, then we get your questions, we answer them, but we also sometimes take them and make them into questions that we're going to go over today. If you need a detailed response to a question, like it's very fact-specific to you, requires tax work or additional effort other than general questions, then we'll ask you to become a client, which you can either do platinum or become a tax client. Either one will get you there. And then we will answer your question in great detail, spending as much time as needed. The whole idea is to make this fast, fun, and educational. Like the whole idea is that you should enjoy learning about this topic because it's going to put a lot of money in your pocket if you do. And there's a lot of fear built around it, and we're just trying to dispel that. So sometimes we seem pretty chill on things. It's because it is pretty chill. Taxes aren't, this is, There are some black and white things that you follow, but there's also just a whole world of gray where you're doing the best you can off the interpretation, off of the laws that are given by the judges and by the regulations that are put forth by the Treasury and by the guidance that we're given, and we try to do the very best we can with that and give you guys things that are in your favor as opposed to interpreting in the favor of the Treasury. Again, it's all about keeping money in your pocket. That ultimately is better for the government. Believe it or not, they actually make more money if you keep more money, which begs the question, why do we still have taxes? That's for a topic for another day. Maybe we won't. Maybe we'll go all to tariffs, which is a tax. Or we'll go all to inflation, which is a tax. Or we'll just keep doing what we're doing, which is a combination of income taxes, payroll taxes, tariffs, which is 1.8% of the budget was collected via tariffs, if nobody knew that. Now you have useless data that you can throw in your head. It's not the big part. The big part is income taxes and payroll taxes, for sure. And then inflation, of course. The government either borrows money, bonds, or they print money, which is increasing the money supply. It gets us to the same place. Your US dollar becomes worth less, and that's a tax. All right, let's go over the questions. Enough of that. You should stop me when I just
No, you're right.
just reach out, go like this. Whack. All right. I need to retroactively claim my real estate deduction or depreciation for my 2022 and 2023 taxes. I actively manage my own rental and have over 700 plus hours per year for real estate management. How do I claim accelerated depreciation for the past years? Interesting question. We'll answer that. I didn't have, here I have to read something else. I didn't have my health premiums added to my payroll statements for 2024. I have an S-Corp and pay myself and another employee but wanted to deduct health insurance payments. Is there anything I can do at this point? Regarding asset protection, we have a rental property and would like to move this into a trust, or move this to a trust, and then to an S-Corp. Would that work? Interesting questions we have. We'll answer those. We'll get to them. I have seen some of your videos and had a question about setting up a trading account under an S corporation. Is this correct? Can I pay my wife $15K from it and then match that amount towards a 401K? Match. Interesting. My wife is a homemaker with no income. If we file jointly, just married filing jointly, are there any implications with this move? We are not traders, but more investors. Interesting question. A bunch of issues in that one. My employer recently went through a restructuring. They offered me 1 year's pay as severance. My last paycheck will be January 2026. I feel confident that I'll be able to fulfill the rep status requirement for time spent on material real estate management activities in 2025. I will not make more money from my real estate investments as compared to my severance pay. Can I still qualify for the rep status? I used my solo 401K to invest in a real estate deal as a passive investor. The bank recently foreclosed the deal. It was a total loss. Is there any deduction that I can take for the loss? Again, interesting questions, and we'll go through them. When is the deadline to make an S election for 2025? Can you switch back to sole proprietorship after you elect S Corp in the same year or future years? Do you have to run payroll as an S-Corp LLC? What are good indicators or reasons to switch to an S-Corp for taxation? Great questions thus far. We'll answer those. I'm converting a barn on my property to an auxiliary dwelling unit for rental purposes. I also have a separate building on the property that I use as a shop office for my construction business. How do I treat these properties for liability and tax purposes? So these are all good questions that we've gotten thus far. There's a couple more. My business doesn't have traditional receipts for its expenses. I always like it when they say, it doesn't have traditional receipts. We just kind of make stuff up. No, teasing. We primarily rely on bank statements to track our spending as opposed to what? I can't help it. I love it when they do this stuff. All right. What supporting documentation would I need to provide to the IRS or my tax preparer to substantiate these expenses and ensure accurate tax deductions? Are there any alternative methods to proving these expenses without traditional receipts? Elliot will probably go over that one. My business partner and I co-bought a condo in New York City by paying $900,000. He put in $700,000 and owned 75%, and I put in $300,000 and owned 25%. I'm deeding my ownership to him for $0. What would his cost basis for future resale? What would be his cost basis for future resale? All right, great questions thus far, and I can already see a bunch of people are in the question and answer, the Q&A. So just as a reminder, you can ask questions in Q&A. We have a bunch of accountants and attorneys in there: Amanda, Arash, Rachel, Tanya, Ross, Dutch, Jared is in there. Let's see, we got a bunch of others. Jeffrey, Troy, Kenny. Oh, Kenny, I don't think she's going to answer your tax questions. And Patty are all there to help you in that Q&A section. So you can absolutely go in there and ask questions. Just know that throughout this, you can do that. It doesn't have to be about the topic that we're hitting on. It can just be any question that you got. And you're like, oh my gosh, I've always wanted to know, how do I accelerate my depreciation? Also, you can always join my YouTube channel. My channel tends to be focused on tax and financial planning more than anything else. It does have a good dose of asset protection. It's absolutely free. All you got to do is go to YouTube and type in my name. And then also Clint has a channel, and his is definitely more focused towards real estate investing and asset protection. So between the two of us, we should get you covered. And then, of course, there are free events that we teach. It's almost on a weekly basis. And the only reason I say almost is because sometimes there's two. No, I'm just kidding. Sometimes we do the live ones, and it might be off by a week. But generally speaking, you could almost always get to a class on tax and asset protection where we're teaching about land trust LLCs, corporations. Amanda teaches those. We have a whole bunch of different folks. Clint and I sometimes get on there and teach them, but Brent Nagy gets on there, and Whitney Chafin gets on there, and just a really good group. Some of them are longtime clients that teach, just because we actually like the idea that non-attorneys are talking in straight language for other investors. And then, of course, you got a bunch of the tax people and the attorneys on there. Sometimes we have to be careful. We start using legalese, not always understandable. So between us, we do a pretty good job of making sure you're well versed on these topics, so you can take advantage of the rules that are out there, so that you can minimize your tax, protect your assets, and create a legacy. That last one probably being the most important thing to me at this point. In my career, what I tend to work with clients on is really thinking out into the future, that 100-year plan, that 200-year plan of what your estate looks like. And before you say, but I'm not going to be around, you're right. That's why you need to document it, to make sure that your estate doesn't get squandered, which it will statistically, pretty much inevitably within 2 generations, if you don't put a plan in place. So we want to make sure that you don't have what they call shirt sleeves to shirt sleeves in 3 generations. You don't have your own version of that in your family. You create something that is lasting for many, many years. How many of you guys want to create a legacy? Like, you want to create actual change in your family where you're passing on your values, and you're passing on something that's going to perpetuate itself over the years and actually have a major impact on your future generations. So I see some hearts. Give me a thumbs up if that's you, or a heart, or confetti. Not a cry emoji, but anything else. So there's a bunch of you guys. I agree. And I just think that a lot of times we have this weird mentality of die and distribute. Hey, I'm just going to leave it to my kids, and you're not doing anybody any favors. Your kids might do okay with it. Statistically speaking, again, 50% of it gets burned away in the first few years just from frivolity or not understanding finances. So we want to create something that keeps that from happening. Somebody put in there the word legacy has lost meaning. I think of it as passing on your values, and I use an example during events, and I'll just use this as an opportunity to infect you guys with it. I have clients that really believe in their heart of hearts that if you travel the world and you see other countries, it's going to make you a better person. And so their trust is all about making sure that their family members and their descendants can travel the world every year and go to a different country. And so that's what their trust is all about. That's what their legacy is. They fund it with life insurance and with their other assets. So think about this. If you were their grandchild or great-grandchild and you said, hey, there's a trust, and every year, 2 weeks, you can leave the United States and go visit another country, and the trust pays for it. Here's a little statement about why they think it's important about, going and seeing the world. That's a pretty cool thing versus just, here's $25,000, right? I'd rather have something that actually has an effect. And that is how you pass your values on, as opposed to just giving somebody cash. Cash, people can burn through that. They can make a mistake. They can get, wrong spouse, broken picker. They keep picking the wrong spouse. And then go to Vegas, get into a car accident, make bad decisions, drugs and alcohol, whatever. And you end up losing what you worked so hard to create. When we create a legacy, they can't touch it. We're putting it in an iron box that nobody can take, that's going to be there for your legacy, whatever you decide it is. And it's actually pretty potent. But that's not why you guys are here. You guys are here to talk about taxes for some reason. You guys are all sick in the head, and you said, really what I'd like this afternoon is to talk about taxes, more taxes. So let's get into this. I need to retroactively claim my real estate depreciation for my 22 and 23 taxes. I actively manage my own rental and have over 700 plus hours per year for real estate management. How do I claim accelerated depreciation for the past years? Elliot.
All right. Well, first of all, this is something I would encourage everybody to look at the returns, make sure they have been taking indeed depreciation for prior years. Sounds like we didn't here, or at least we didn't take enough. Yes, you can go back and retroactively capture previous depreciation, including accelerated depreciation or bonus depreciation, things of that nature. Usually there's a form, though, you're going to do it in the current year. It's a form called 3115 or 3115. There you can, we have an adjustment called 481A adjustment, and we can capture previous bonus depreciation or things like that, or any missed depreciation, get that cut up in the current year. I'm not so sure if it would be all that effective to go back and amend. I'm not sure you could amend if we're dealing with accelerated depreciation in prior years, but I certainly know you can do it in the current year, catch it back up with that 3115. Your tax preparer professional will know how to work that document and get it into your return. I also picked this question here because we see here, Toby, they're asking about managing their own rentals, have over 700 hours. It sounds like they're getting into the world of real estate professional maybe going on there. And just to lay it out there, why do we care one way or another? Normally, rental activity is what we call passive. If we went out and got this depreciation, maybe it creates a loss. But if it's in that normal realm of passive, it's going to be a passive loss. You can't use that passive loss against anything else but other passive income. So what one wants to do many times is they or their spouse will go for real estate professional status. That means you turn it in from passive to active or non-passive. But to get there, we have to have over 750 hours, not 700, at least 750. It has to be over 50% of your regular work week. That means if you have other jobs, you have to do more in real estate than the other jobs combined, okay? And then lastly, you have to personally manage, you and your spouse can personally manage materially, participate in the management of your own personal rentals. That has different tests for it. Most common, over 100 hours and more than anybody else. But if we meet all that standard and we get the rep status, well then yes, we can go back and claim these things and get these deductions. But you're gonna need to document those hours, keep a log. We have software out there, or not Anderson software, but there are providers out there with software that will help track those hours. So all things that you'll wanna think about, but the quick answer is yes, you can go back and capture that. You do need to do the Form 3115. The impact of it will depend on whether or not we were real estate professional status.
Yeah, so you just threw a ton at them.
Yep.
So I'm just going to pick
Really
little
good. Yep.
pieces. So when you don't claim depreciation, you should know this. I own a piece of property and I don't depreciate it, but it's an investment property. I have to recapture the depreciation that I could have taken but didn't when I sell. So it's a nasty surprise when somebody has that second house that they're renting out, but they're like, I'm not making any money. You may end up having to pay tax on that portion that you didn't. So yes, you can catch up any year. You can say, here's the depreciation that I forgot to take, and I'm going to take it in this year. So for our purposes, what would that be? 2024. Right. So we can take it, but now the question is, can I accelerate it? Can I change the way that I depreciate it from being 27 and a half years for residential or 39 years for non-residential? Can I change that and write it off over 5, 7, 15, 27 and a half or 39 years? So the answer to that one is you can't do that for 2022 or 2023 at all. You could do it for 2024, and you could make an election to do that at any time before you file your taxes, plus extensions. So October 15th, or if it's in an entity like a partnership, then it would be September 15th. But you're changing your accounting method. So that's the 3115 that you were talking about. Then, now that we have depreciation, if it creates a loss, then we say, is that a passive loss or a non-passive loss? And if it's from a real estate activity, the presumption is that it's going to be passive. So if it's investment activity, long-term rental, there are 2 exclusions. If you're an active participant in real estate and you make less than $150,000 a year of adjusted gross income, then you could write off up to $25,000. It phases out between $100,000 and $150,000. $1 for every $2 above that amount. So you get a $25,000 deduction at $100,000 AGI. You get 0 deduction if you go above 150. But that's exception 1. Exception 2 is what Elliot went over, which is the real estate professional status. And then sometimes we say there's a third one, which is it's not actually investment activity, it's short-term rentals. in which case that's treated as an ordinary business. But whatever the case, you go through and you say depreciation first. Am I going to accelerate that depreciation? You have to do what's called a cost segregation study. It'll say what percentage, and then you can see whether it makes sense. Usually, we do our business with Cost Seg Authority. So if you went to AndersonAdvisors.com/CSA, I think that's maybe Patty has the link out there. They will do a free analysis to tell you whether it's even worth it to consider. So they look at your depreciation schedules in the property. They've done like tens of thousands of studies, so they have a really good idea of what they're doing. And then they say, here's what the numbers would be, so you can see whether or not it makes sense. So for this particular individual, it would be paramount to figure out what amount of depreciation can they grab, how much would it be in this particular year, does it create a loss? Because if it doesn't, then we don't worry about real estate professional status. If it does create a loss, do we meet any of the exclusions? And is it actually in a passive real estate activity? That's all we do. It sounds like a lot. Elliot could do that in about 2 seconds if he decides, oh, this, that. And you're like, oh, blah, blah, blah. That's why you work with somebody who knows what they're doing, because they're just going to say, here's what's relevant, here's what we don't, like, let's not pay any attention to this yet. Let's just look at A, B, C. In that order. A, what's the depreciation? B, are we at a loss already? Should we accelerate the depreciation? Should we do a cost seg? Yes. C, does it create a loss? Do we want to use that loss against our other income? Okay, then here's this. If A and B, like we don't even get past A, then we're not worried about it. And then you don't have to waste your energy. But really good question. You get, what can I do? I need to do, hold on. All right, enough of that. Move on. I don't want Elliot to get too excited. He gets very... All right, I didn't have my health premiums added to my payroll statements for 2024. I have an S-Corp and pay myself and another employee, but wanted to deduct health insurance premiums. Is there anything I can do at this point?
All right, well, if the S Corporation pays for our health premiums, it needs to be part of our wages, our W-2 wages. So we stack that on top of our regular payroll, which in an S Corp, we often have what's called that reasonable wage, W-2 wage. So we add that on top is normally what happens. That becomes a deduction to our S Corporation as salary paid to officers. Comes onto our personal 1040 as a W-2. We're all used to our W-2s. And then on our 1040, we can make an adjustment on Schedule 1 for the insurance premiums because we're considered sole proprietor in this situation. So that is something that we could do here if we forgot it, but the S Corp has to have been paying those premiums. In that case, if we're in that scenario, then we can go back and we can amend the W-2s, do a corrected W-2, and then we would declare that on our 1040 again, and then we would take the adjustment for those health insurance premiums on our 1040, and we should be good to go. Now, if the situation here is, well, no, Elliot, it's not that I forgot to put them on my W-2 as income. My S-Corp just didn't pay them. It never paid for my personal insurance premiums. Well, then we got a problem, okay? Because it never paid for it, so we couldn't do it that method of getting it. Maybe you have some other kind of business, perhaps on your return, maybe a Schedule C where you're considered sole proprietorship, self-employed, and then you could do it that way if you personally paid for your premiums. But absent that, I'm not sure.
What if they just didn't pay the premium?
Yeah, if you didn't pay it all, then no, there's no deduction for that.
You're a cash basis taxpayer. You can't write off what you didn't.
That's correct. Yeah.
But if you did pay for it, you can't deduct it on your W-2. It's going to come through as an income item because you're greater than a 2% shareholder.
Yes.
The employee would not have to pay tax on it, but you would. But then you get a deduction for the insurance premium that you paid on your 1040 as a self-insured or a self-employed individual. So you don't get to, it might freak you out. You might be like, hey, I don't get to write this off. You don't get to write it off on the business, but you get to write it off. On your individual. Somebody says there's a long queue for Q&A. Don't worry. We'll get through them. We got a whole team. We got Troy, Jeff, Patty, Kenny, Jared, Dutch, Tanya, Ross, Rachel, Arash, Amanda. We got a whole team. So Josh, submit your question, please. We'll make sure we get to it. You'll actually get it answered 100%. These guys are beasts. They're tearing through this.
They're almost up to 100.
Yeah.
They're 80 some
Yep.
right now.
Yeah, so like 20 is nothing. 20 is nothing. They'll knock that out in a few minutes. So go ahead and post it, my friend. We'll make sure. We'll get you. And we never really, like, we always stay on until we answer all of our questions. That's a secret. But for people that stay to the end, some of you guys do, you know that we'll sit there and we're like, hey, we'll keep it going. Even if I stop and Elliot and I disappear, we'll say, don't worry, we're not going to stop until the last question's answered. This is for you guys. So we strongly, like, we really believe that. Like, this is our giving back. We know it's difficult out there to get a straight answer from anybody, let alone a tax professional. I sit next to this guy and I lose my mind. No, it's great. These guys are pretty good. But we just want to give you guys an outlet, because I don't know about you guys, but for me, I could never get an answer out of an accountant to save my life that I could actually use. It was always like, there was a great joke of a guy. He was a balloon racer. He would get in those hot air balloons and race across the country, and he got into a bunch of tornadoes hit and swung him all over the place. He didn't know where the heck he was. And he lowers down, and there's a field, and there's a guy dressed in a blue blazer and a light blue shirt with a briefcase. And he calls down to him and says, hey, down there, can you tell me where I'm at? And the guy in the farm reaches up and says, you're in a hot air balloon. And the guy's like, he must be an accountant. Accurate, but useless.
From Iowa.
Yeah. We love our accountants. All of our CEOs. There's a bunch of you guys out there. I know it. I'm no better. All right. Regarding asset protection, we have a rental property, and we'd like to move this to a trust and then to an S-Corp. Would this work?
And this is an open-ended question, but when I see these, I see peril, I see danger coming, so I try and pick them. First of all, obviously, we're not here to talk so much about asset protection as much as we are tax. And if there's one rule that we have in tax that doesn't seem to change, it's about the only thing in the code that doesn't, you never put appreciable real estate into a corporation. S or C, LLC taxes S or C, any of the above, you don't do that. So that's why I kind of grabbed this.
Unless
We're flipping property. Then all of a sudden, yeah, we absolutely move all those in there to flip. Why? Because we just have different treatment in the tax code between the two. But a rental, you're going to suffer far more tax consequences if you put a rental into a corporation, a long-term hold like that. And that's why I picked it, even though I was asking about asset protection, because that is a very severe tax aspect to it. Just know also, we hear a lot of people, hey, I know I'm going to flip, and so I'm going to put it in an S corporation. I saw Toby's video or what have you. Just remember, when you do that, though, you can't do installments, okay? That's considered inventory. Part of the big difference between why we do flips in an S-Corp and why we don't put long-term holds in there. So I just throw that out there as well, because that always seems to be a second problem that we run into.
I would say there's one other time that you have real estate in an S-Corp, and it doesn't hurt you if you buy and sell in an S-Corp. What hurts you is when you take it out to refinance it in an S-Corp, because it's treated as wages. It's literally like somebody just paid you in a house. So you have the active tax on it. Like, it's horrible. It's catastrophic. So you never want to do that. But if you own a house free and clear and you're never planning on refining it, we do this sometimes when somebody owns a home that they lived in it 2 of the last 5 years, and they're about to go past the 3-year period, and they're going to keep it as a rental, but they don't want to sell. But they want to take advantage of the 121 exclusion, the $500,000 capital gain exclusion, because it's going to save them. Figure they're in the top bracket. It's going to save them, 23.8% of 500,000, which would save a lot, whatever that amount is.
Just over 100.
Yeah, a lot of money. It saves you a bunch. So in that case, you're like, okay, but just know that if you take it out to refi it, you're going to have a problem. So we just keep it in the S-Corp. You can depreciate the heck out of it again, because now it's going to step up with the 121 exclusion. You do an installment sale, opt out of the installment sale method, so that you can take all that $500,000 gain is, you're tax-free. And that's the only other time we do it. So S-Corps are good for flips. S-Corps are good when you're you need to rescue yourself and use your 121 exclusion. We'll get that. Who is the non-Toby person speaking? That's Elliot. Elliot's a tax attorney.
Definitely
Elliot
not
Thomas.
Toby.
And he's a really good guy. There's a bunch of other questions. Where do you type your questions? The Q&A. But if you're moving that rental property, first off, they're using a trust. I'm assuming it's a land trust. And then you can point it to the appropriate entity. It may be just a regular old LLC, plain vanilla. It might be disregarded. But we'll get you there. Who is the non-Toby? I like that. Non-Toby.
I've been called a lot worse, so I'll take it.
You're a non-Toby. I have seen some of your videos and had a question about setting up a trading account on an S corporation. Is this correct? Can I pay my wife $15,000 from it and then match that amount towards 401k? My wife is a homemaker with no income. If we file married, filing jointly, are there any implications with this move? We are not traders, but more investors. What do you think?
Yeah, so I'm going to let Toby cover a lot of territory here, but I'm just going to give the brief outline here. Typically, no, we would not put our trading into an S corporation. We put it into a trading partnership, where the brokerage account is owned by the partnership. You have a C corporation in there owning a certain percentage, usually a smaller percentage, maybe 10%, could be more. Then you individually would own the other 90 or what have you percentage. What that does is it starts to shift some income off, a little bit off your return. The corporation could be a member, a partner that's doing some of the work, overseeing, maybe managing the situation, so it can be paid an additional amount called a guaranteed payment. That adds a little more tax savings and puts a little more in the C Corp. Why do we like that? Because the C Corp has a lot of reimbursements and things that we can take advantage of to get that money back to you tax-free. So effectively, when it's all said and done, we take a portion of that money that you made in your trades, maybe get it back in your pocket tax-free when it's all said and done. But there's a lot more to that. Again, I'll let Toby handle that. But if you get to the C Corp and you have a lot of money in there, now you could have your spouse paid as an employee, contribute to a solo 401k. It certainly could set one of those up. We do it all the time. Set a lot of solo 401ks up for these types of C corporations. Again, underneath that trading partnership. So yes, your spouse could do that. You could do that. Married filing joint usually is the way you want to go if you're married. So that's not a problem. We run into that all the time, and it's not an issue at all. As far as the traders and investors, I'm going to let, in all the other real details here, I'm going to let Toby handle it.
Yeah, so whenever we're talking about trader status, I just want to be real clear with you guys about a couple of things. First off, trader status just means at what point do you go from having 212, which is investing expenses, which are very limited, it's just the interest on a margin account, to Section 162, ordinary necessary deductions from a trade or business. And they don't define it anywhere or what it means to be a trader. So since it's not in the code and it's not in the regs, then you have to go in front of judges. And so the courts have grabbed this and said, hey, here's what you have to do. It's frequent, regular, continuous. And they interpret these things to be like 70% of the trading days. It needs to be your major source of income. And it's pretty arduous. We try to avoid messing around with trader status. By using the strategy that Elliot just put out, which is to use the partnership and a corp, you get around that because the corporation is just a management entity, which is for forever. You can always have a management entity and it's a trader business by being a manager. The LLC or the LP tax as a partnership, either one works, is just a pass-through entity. We're not trying to make it a trader. The only expenses that are getting written off are through the corporation. So the question is, could you do your type of activity through the S-Corp? And I would say it depends on whether you qualify as a trader. If you did, I'd say, let's do it through an S-Corp, but you don't, so I won't, right? I wouldn't. I would not do that under your circumstances. I would do what Elliot laid out, and I would have it in a partnership with the corporation. Now, once you get it there, and you start, let's say the corporation has 20% or 30% of whatever that is, and it makes, in your case, let's just say it makes $30,000. And you're like, how do I get this into a solo? Can I do that? And the answer is partially yes. Your wife actually has to do work for the business and document her time so that she qualifies for the compensation. You have to run it through payroll and run that if she's taking 15,000, there are payroll taxes on it, old age, disability, and survivors, and Medicare. So that would have to be paid. And then you defer it straight into a 401k. So there'd be some tax. It's going to be small. It's going to be 7.65% for the business, 7.65% for the recipient. So you're losing about 15% of $15,000. So whatever that is, 50 about 2,000 about $2,000, and it goes in there. Now, can the company contribute another $15,000 on her behalf? Technically, yes, but it could only deduct 25% of that amount. So 25% of 15,000 would be 25% of 15, whatever that is, like 3,500 or whatever it is, 3,570, whatever. I get my calculator out. So you could only deduct a portion of it, and the rest of it would be taxed at the corporate level, 21%. But now your wife has 30 grand sitting in an account, and you wrote off. Let me just think if I could do the math in my head. Just under 20 grand. So that's not too bad, depending on what you guys do with it and what tax bracket you could be at. That would be a big win. But yeah, there's no free lunch. You do have to do the payroll taxes. The employer does have to make the contribution up to the amount that she's paid. 25% of it would be deductible, and 75% would be taxable to her as wages. That's it. You do that, and you're going to be doing all right. And again, it's just numbers. Is this worth it? Is it worth it to pay, about $4,000 of employment taxes and a little bit of, what would that be? About 12,000 times 21, about $2,500. So maybe $5,000 in tax to get $30,000 into a retirement plan. Is it worth it? Yeah, probably. It'll be just under 30 grand because it'll be whatever your net is. But that's how you look at it. And I wish it wasn't so flippin' complicated, but until Congress writes a law on it, or until we get some, maybe they'll do regs on it someday, but otherwise we have the courts as our guidance, and it tends to be a battlefield. So we try to avoid the battlefield if we can. Anything I miss?
No, I think we're good.
All right, a little Ric Flair action. Let's see. My employer recently went through a restructuring. They offered me 1 year's pay as severance. My last paycheck will be in January 2026. I feel confident that I'll be able to fulfill the rep status requirements for time spent on material real estate management activities in 2025. I will not make more money from my real estate investments as compared to my severance pay. Can I still qualify for rep status? Elliot, what do you think?
All right, so again, just a real quick over rep status, real estate professional status. This is where we're trying to turn our real estate activity from what is typically passive into non-passive. We usually have a tax benefit behind all that. 3 basic requirements, at least for rep status, there's 2, over 750 hours in real estate trades or businesses that you materially participate in. Over 50% of your work week is in real estate, again, real estate traders or businesses that you materially participate in. That'd be opposed to other jobs. Here, if we're not doing anything else, then we should be able to cover that. And then you have to materially participate in the management of your companies as well, or excuse me, your rentals as well. Sounds like that you think you'll get that here. And so we check that box. Good, we have it. Then we come down here and we say, well, we're not making as much money from the real estate investment as how much we were getting paid in our severance, maybe what we're going to call W-2 perhaps on our return in 2025. That doesn't matter. It's a very common thought that you have to make more money, or if you have any W-2 that you can't get rep status. Really what it comes down to is if you did anything, you're going to track your hours, and you're going to show that you did nothing to get that severance pay in 2025. That was all previous. So that shouldn't be too hard to document. It's going to be meeting the other requirements of real estate professional, but having how much you make is irrelevant. It's all about time.
It is about time. I was sitting here looking at this going, okay, you're getting a year's severance, but you're leaving now. So my guess is that they're not working. So then they spent time on a material real estate management activity. So it sounds like the first step is, did you do 750 hours in that real estate management activity that you materially participated in? And then the next step will be, did you materially participate on your investment activities? And if you did that, then you qualify for rep status, and you could use losses that you create. That's always the big factor. Can we create real estate losses? If we can't, then we don't care. Like, you don't need to do rep status. If you can, then we want to see if we hit rep status. And it looks like it probably would. My guess is that it sounds like it probably could, but is it worth it?
And if you do get that loss, yes, that will go against your severance pay that you're claiming in 2025. So it could work out really well.
And somebody asked a question in chat that I didn't answer from before. There was the other one. There is the other exclusion, exception to the passive activity loss rules, which is the active participation. And if you have a husband and wife and they decide to file separately, it does lower the phase out from 150,000, from 100,000 to 150,000. It cuts it in half. So it'll be what, 6,250 to whatever it is, to 75,000.
50 to 75.
Yeah, so that's the only tip. Otherwise, for single versus married, there's no difference. Kind of weird. But if you did active participation, so in this particular case, if you created a loss, and let's say it's $10,000, and you made $110,000, you don't need to jump through the hoops on real estate professional. You would have enough. You would have $15,000 of loss. The difference between 100. Basically, you're at 100. You'd phase out $5,000. So I guess you'd have 20,000 that you could write off. $2 for every dollar over $100,000. So if you were at 110, you'd phase out of $5,000 of the $25,000 of active loss. So you'd be at 20. You'd be more than enough to write off that loss. That's why I always say we go through steps to see whether or not it's even worth jumping through those hoops. Because you track your time all year and then you find out you don't need it, you're gonna be a little ticked. You're gonna be like, I just did I kept a log for what?
I listened to Toby and Elliot about this for why.
Yep, that's exactly right. So we don't want you to waste your time. So sometimes it's as easy as saying, is it worth it? It is. You're either gonna be in the realm. If you're in the realm, then maybe we track it, but otherwise it's just. All right, I used my solo 401k to invest in a real estate deal as a passive investor. The bank recently foreclosed on the deal, I'm sure is what they meant. It was a total loss. Is there any deduction that I can take for the loss?
Yeah, unfortunately, no. What's going to happen when we talk about a retirement plan and an money goes out into an investment, that investment's sold or pays some kind of income or something, and it comes back into the plan. So we have money going out, money coming in. If it goes out to an investment and it's lost, it's just that money doesn't come back in. There's nothing to write off. There's no deduction in that nature. It's not like in our personal world outside of a retirement plan. So no, there's no deduction. We simply have the drop in the value of our plan.
Yeah.
And hopefully we'll be able to get some better investment.
And I wonder, because I don't even think like if they stole it, I think you're still toast, because you took a deduction for it going in there in the first place.
Yeah.
So I think that's where you're at a problem. But even if it was like a Ponzi or something,
Yeah, that still has to be outside the plan.
has to be outside the plan. So I think.
Nothing for you.
Yeah, it's a good question.
I think you're toast.
Yeah.
I hate to say that, but on the good side, is that hopefully you have a whole bunch more that you're making in there. It always sucks when real estate deals or whatever deals don't go well. You have foreclosure. That you were in the right entity if you had debt, which is you don't want to be in an IRA where you're having a UBIT or UDFI because you had debt and then lose it that way too. It always sucks. I mentioned this earlier, so I'm just going to mention it again. If you'd like to join us for any of our tax and asset protection events, we go over what are LLCs, how to use the anonymity shield, privacy trusts, land trusts, living trusts, tax planning, cost segregation, bonus depreciation, all those things we do in a one-day setting. We also have our live 3-day event coming up in March. So it's March 27th through the 29th. You see it down there in the lower corner. It says Tax and Asset Protection Workshop in Dallas, Texas. This is a live get-together. These are actually really fun because we all get together and hang out for a few days. It's actually a total of 4 days. You could do 3 days for the tax and asset protection. Then we have a client appreciation event. If you're a client of Anderson, you could join that, where we do a bunch of networking, and that's on Sunday. So there's actually up to 4 days. Reach out to us. We'll tell you all about it if you want to learn more. But if you are brand spanking new, you're not an Anderson client, then and you want to come around the community, meet people, and just see, like, is this person real? Is everybody real? What is the community like? It's usually several hundred people and all investors, and we all have a really good time. Texas is always a good time, unless it's 100 degrees and 100% humidity, in which case then it can be miserable.
Probably not in March, though.
Yeah, March is going to be good. I think we did it in June last year, and I think I walked outside the hotel, and I may as well have taken a shower in the valet. I was like, holy crap. I walked like 3 blocks, and it looked like I just ran a marathon. That was nasty. I'm sure I smelled good, too. Let's see. On a retirement plan loss, is there a total loss if total that comes out of a retirement plan is less than the amount put in? No. So, Robin, you got a deduction going in. So if it was a Roth, you can always take out your contribution tax-free. So if this was a Roth and you put it in 100 and that now you're only taking out 75, you wouldn't have any tax. But if you put in 100, you got a deduction for 100, putting it into a traditional plan, and then you took anything out, it's taxable. That's why it sucks. But it's less,
Yeah.
right? Let's say you put in 100 and you lost 25, it's 75,000 is all you're paying tax on.
Yeah. Guess that's one way of looking at it.
Yeah, it still sucks. No getting around it. That would be a bitter pill to swallow. All right. When is the deadline to make an S election for 2025? Can you switch back to sole proprietorship after you elect S-Corp in the same year and in future years? Do you have to run payroll as an S-Corp LLC? What are good indicators or reasons to switch to an S-Corp for taxation?
So clearly this is kind of centered around the S corporation. In order to make that election, we have to file a form 2553. It's very common. The traditional rule, kind of what it says in the paperwork there, is that you have to have it filed by March 15th of the current tax year, or if you open it up later on in the year, you have, what is it, 2 months and 15 days, 15 days into the third month, which would be equivalent to March 15th if you start from the beginning of the year. That's where typically the form is going to tell you. However, there's something called late election. Very common. We do it all the time. The IRS is very good about allowing it typically, but you have to put additional language on and say, hey, I didn't get it in by March 15th. I was a little bit late. Got it in, and we have some reasons that we put on there. You have to have special language in there, but usually IRS is very open to accepting the late election. They don't have to. You just have to be aware of that. The IRS could deny it. So if we want to be safe, we want to do it by March 15th, or again, 15th day of the third month if it's another time during the year. Once we do that, could you revoke? There's a special procedure you have to go through to revoke. You have to have a letter sent to the IRS to a specific department listing all these items that you are trying to revoke, etc. Could you do that in the same year? I'm not aware of anything that says you couldn't. So let's just say we started out January 1st as an S-Corp, made that election right away, and then at June 30th we thought, hey, this isn't for me and I want to revoke. I suppose you could. You would do a short return for that first 6 months on an S-Corp return, which is an 1120S. Then you would probably have a sole proprietorship for the end of the year. We don't normally see that, and I wouldn't. It sounds like a lot of work, so probably.
You have a 5-year.
Yeah. Once you revoke, though, it's going to be another 5 years. You have to wait until you elect the S-Corp election again. So, yeah. So it's something that you don't want to play around with. You don't have to. You want to make your decision, stick with it. Do you have to run payroll? Well, if you take a distribution, if you take money out of your S corporation, then typically you will have a requirement to pay yourself what's called a reasonable wage, i.e. payroll. So yes, we could. If we didn't take the money out, then there is no requirement to pay that reasonable wage. So that's just something that's more, when we get into the tax planning. When do we decide to do an S corporation? Well, as Toby mentioned earlier, maybe, usually for a business, I'll say this first, we kind of, as a rule of thumb, maybe if you're making 30 to 50,000 net, that might be a good time because we would start to save on employment tax, because that reasonable wage is going to be taxed with regular income tax and employment tax, but the rest of the money from your S corporation, which we call distribution, it's not subject to employment tax. So you might have a savings at $30,000, $50,000 in net income if you do a little bit of reasonable wage and take the rest without being hit by that extra tax, 15.3, for the employee and the employer split between the two. But Toby mentioned another time where you might want an S corporation. Maybe you're selling your former residence that's gone up in value to an S corporation. You're going to turn it into a rental. That's a little bit different. That would be a good reason, but unrelated to an operating business in the sense of, what I'm talking about, where you normally have a trader business outside of rental. So those are kind of the ways we would look at this.
Yeah, so I guess what I would say to this person is if you're on the line as to whether it be an S or a sole proprietorship is to wait. Because you can make easily make a late election before the end of the year, and then you could even make a late election after the end of the year if you needed to. There's relief that gets granted. Like, I can't remember the last time it wasn't granted.
Only time I tell clients this all the time, I've only seen it once that it didn't get granted, and I wouldn't have granted it either. It was just a bad fact pattern. Won't go into the details, but it was. They always have been very good at accepting it.
You're going to get it, right? So if this is, hey, I'm trying to figure out what I should do, just sit on your hands. Otherwise, it would be, March 15th to make the election?
Correct.
So, but if you're making over $30,000 a year, then I would say that there's two big reasons why you do the S-Corp. Number one is the profit that flows through doesn't have the employment taxes, and number two is because you get an accountable plan. So like when you're a sole proprietorship and you use one of these guys, these little phones, you can write off the business use, but you got to track the business use. If you're an S-Corp, it can just reimburse me the entire amount, doesn't have to worry about it. And that goes for computers and goes for having an administrative office in the home. I don't have to use that silly home office form. I don't have to do the Form SE that you do as a sole proprietor. Like, people don't realize that you have these extra tax forms that you have to file, and that's what causes you to get audited. There's always accountants that are out there like, sole proprietorship doesn't cause you to get audited more. I've never seen that. It's not the sole proprietorship, guys. It's the Form SE and the 8879, and that you're putting a big old, you're waving a flag saying, I'm pretending to be a business because I think I am. And then they take a look and they say, all right, let's see what kind of records you got. And they win 95% of the time. So they just nuke you. So statistically speaking, if you're making 100 grand a year, you're going to get audited about 800% more often if you're a sole proprietor. That's just stats. It's actually higher than that. It's 800 to 1600% more. You're going to lose those, be real with you guys, 94% of the time and 95% of the time, depending on whether it's a correspondent or an in-person audit. So you get your butt handed to you. Why? Because you believe somehow somebody told you that a sole proprietorship is just you. It's not. You actually have to keep the same book and records as you would if you were an S-Corp. So all that it happens is that S-Corp is giving you relief of about 15.3% on any amount that you're receiving that's in addition to a reasonable wage. And that's only if you take money out of it. If you leave all the money in the S-Corp, you don't even have to take a wage out. So if you're just using it as hey, I'm working my butt off, I'm doing a side gig and I'm saving my money and I'm going to, I want to buy some equipment or I want to buy more inventory or whatever, you don't have to worry about taking payroll. You just don't have to pay that 15.3%. What does that mean practically on 100 grand? That's the actual math on it is about $14,100 per 100,000. There's a phase out, there's all these nuances, but for people that are, let's just say you're $100,000 and below, that's an easy one. It's just say about 14% is what it's going to save me. And if you're below 30,000, then I would say it's a push, because even though it might save you a little bit of money, it costs you money to do that extra return, which is really the same information that would be on your 1040 anyway. We're just putting it on 1120S, but all accountants charge extra for it, right? They're never going to say, oh, this is your 1040. It's not. It's a separate return. So they're always going to charge you for that second return. So there's a little added cost. So you just want to make sure it balances out. And it's right around 25, 30,000, depends on your business. I hope that helps you. There's a question down in the chat that on the 401k distributions as it relates to taxable events. You do not have to take, so this is for David and Dorothy. If you have a 401k and it owns a partnership interest in an LLC, it's not a taxable event to you to have income in it unless it's UBIT. If it's investment, like you're doing real estate or you're passive, you're fine. If you're running a McDonald's and it's kicking you a K-1 with profit, then you could have what's called unrelated business income tax. But assuming that it's just investments, you don't have to worry. It's when you take money out of the 401k that you have a taxable event. And the way the IRS makes sure that you do that is something called required minimum distributions when you hit age, what is it, 74 now? 73, 74.
72, but yeah.
Wait, what is it now? I'm going to ask my accountants. Hey guys, what is the year that you have to take required minimum distributions out? Is it 72? Ellie and I are just sitting here. Somebody can look it up. Maybe they can let us know. We got all these accountants out here. We got a bunch of you accountants that listen to. Bail us out. 73.
Yeah.
73. Wait. I need something. Shoot. I need something. Well, I'm like a broken clock. All right, enough of that. 73 and going up to 75. Yeah, and there's some weird stuff going on. Hey, I need every little bit I can get, guys. I have cats. They don't clap. You could be doing some great stuff, and all they do is just
Look for food.
they just look at you and go, did you feed me? Thank you, Gabriel, Arash, Troy, Greg. You guys need a little accountants to the rescue. We should come up with a good title. Undercover accountants. That just sounds dumb. All right. I'm converting a barn on my property into an auxiliary dwelling unit for rental purposes. I just got to say right now, I'm kind of jealous that you have a barn.
Yeah.
I don't know. It's a guy thing. I don't know. If you say you have a tractor, then I'm really pissed. All right. I also have a separate building on the property that I use as a shop office for my construction business. Now I'm really jealous.
Probably with the tractor.
I bet you have some heavy equipment. I'd like to go right around. That just sounds wrong. How do I treat these properties for liability and tax purposes?
All right, so as far as the tax purposes, the ADU, the auxiliary dwelling unit, that's going to be either a long-term rental or a short-term. That just depends on the average number of days per stay. If it's under 7 or less, then it's typically short-term rental. If it's over that, generally it's long-term rental. You would just report it on your return, depending on which it is. The depreciation on your short-term rental is typically 39 years straight line. Your long-term rental, 27 and a half. That'd be some of the tax aspect here, unless you do some of these cost segregations and things like that we've talked about. As far as the construction building, it would depend. If you have an S corporation that which encapsulates the business itself, it does a business return 1120S, or a C corporation, or maybe you could be using that as kind of the admin office or something like that. If it's attached to your house or something, I guess it is a barn, so probably not. But you could pay it rent or something like that. But as far as the liability portion, we might try and put this into an LLC. Toby, you were talking about maybe if it has its own address or something like that, perhaps that could help.
Yeah, so there's a couple things. So you have separate units. You have detached units here. So you can actually kind of treat them as separate properties for tax purposes. So if you want to 1031 them, you can actually separate them from the home, and you can still use your 121 exclusion, your capital gain exclusion on your house. I'm looking at this going, is there a house? I assume there was a house, but this might just be a property with a barn and a building that they use. I'd wrap it in an LLC, and if there's separate parcels, then I put each one in a separate LLC so that they don't infect each other. Or you put them all in an LLC and then strip the equity out so that there's nothing for anybody to take if anything bad happens. And how do you strip the equity out? You get a loan, or you loan it money from yourself. But from a liability standpoint, I would isolate them from you for sure. From a tax standpoint, I would just let them flow onto my Schedule E, just like anything else. If you have Wyoming holding company that's taxed as a partnership, that's great. You could run them in through there. It's still going to end up on your Schedule E, page 2. Or if you don't, you just want to not have a tax return, then it ends up on page 1 of your Schedule E. But either case, it's flowing through. I just got to mention, Ginger says, hey, not a guy thing. I love my tractor. So this is for you, Ginger. Because that's kind of cool. She's like anybody that rides. Clint has a tractor now. He goes over to his kid's house and drives around when his wife's not watching. Wait a second for Toby. Kenny Chesney, she thinks my tractor's sexy. I should be a country guy. I'm just jealous of everybody's tractor.
I grew up with a tractor, actually.
I don't have a tractor. I have 2 cats. It's not a good combination. All right. I imagine that when I'm not home, they're riding around on tractors. That's what I like to think. No, they're very cattish. All right. Moving on. My business doesn't have traditional receipts for many of its expenses. Never tell that to the auditor. We primarily rely on bank statements to track our spending. What supporting documentation would I need to provide to the IRS or my tax preparer to substantiate these expenses and ensure accurate tax deductions? Are there any alternative methods for proving these expenses without traditional receipts?
Yeah, this is a great question, very popular question this time of the year, no doubt about it. There isn't an actual requirement that you keep receipts per se, but especially if they're not traditional receipts, you can have other things, like a bank statement could be part of verification. Canceled checks, credit card statements, something to show what you bought, when you bought, and something of a description of how it was used in your business. That's really what the IRS is looking for. It just so happens receipts conveniently have a lot of that information put together. But just a list of who you paid, the amount, proof of payment, which would be the statements or something like that, or a canceled check, the date, a brief description.
Unless you're traveling.
Yeah.
If you're traveling and it's $75 or below, you don't actually have to do.
Except for the lodging part, that we still have to keep documentation. But yeah.
Is there lodging below $75?
Not that I'm aware of.
Yeah, no. If you're driving, so if you're traveling and you got 75, but the IRS doesn't. They're not like if they start thinking you're making stuff up, then they're really going to press you. But if you show good books and records, like if you just have your records and you have these basics, where was this? Oh, this was I met with my accountant at Echo and Rig, and we talked about this, and and here's the credit card statement. They're not going to freak out at you. You've gone through that a few times. That said, it's probably a good idea to keep them anyway. I hate receipts. I'm just not.
We did have the one client that brought us a literal. It wasn't a shoebox. It was a tackle box, about yay big, full of receipts. And I had my buddy Eric Day handle that one.
Said, here, Eric, Merry Christmas. And Eric was like, never talk to him again.
Nope.
He left.
It was silent for a while.
He left right after that. He was like, Elliot, I'm not going to say anything. Here's my, Sherry, goodbye. She's taken off. We know our people out there. We know who you are. You guys are great folks for coming and joining and hanging out with us. And so we're all a big family here. We've done, 200 and some of these? Matthew, how many is it up to? Or Kenny, does anybody know?
236.
236? How do you even know that? Is that written
I have
somewhere?
to type it up every week.
Oh, it's 236 of these. All right. It's a lot of
Part of
hours.
getting the questions.
We used to do like 3-hour sessions too. So Sherry says, I am with you almost 15 years now. That's fantastic. It's always fun. We get to, Sherry and I went motorcycle riding when last time we were out here. It's always fun. And we go to Batista's Hole in the Wall. All right, my business partner and I co-bought a condo in New York City by paying $900,000. He put in $700K and owned 75%, and I put in $300K and owned 25%. I am deeding my ownership to him for $0. What would his cost basis for future resale be?
So whenever basically this is a gifting, it wasn't, they didn't sell it, so for any amount, so you just carry over the basis. So that recipient of the gift would get it at $300,000, that'd be the basis. You may want to file a Form 709 showing that, if it was a gift, just to declare it so that there's not any gift tax on it. Might be a consideration. Maybe there was some kind of, I don't know how there could have been another business arrangement here because that would seem to be a sale. So I can only think it's a gift, and so you probably do want to have someone file that 709.
Yeah, if there's nothing in exchange, there's no anticipation that you're going to get anything of value, then it would be a gift. And the gift is, Elliot just nailed it, it would be that your basis. So assuming your basis is still 300, that it didn't get moved in the last few years, then his basis is your basis. If it's not that, and you're actually getting something, then it gets a little more complicated. If you're doing something below market, then there could be a taxable event. Like if you sold it the 300K for 100K or something, and you could have an issue. You might have a capital gain of 200,000 or whatever the difference is. Again, we'd have to look at the tax return. Chances are you do this is a gift. You do a gift tax return. You track your basis. That's his basis, and voila, you're out of it. Your accountant just makes a note. All right. I think we're getting there to the end. Hey guys, if you like this type of stuff, we have lots of replays. We also have lots of additional video. My YouTube channel is absolutely free. Let's see how many subscribers, 460,000 subscribers. We're almost up to 1,000 videos. I think at 1,000, I explode. It's coming. It's coming. But you could absolutely pop on there. You'll also see there's a free emergency binder. I'd actually suggest that everybody that you know take advantage of that. It's where you track all your passwords and like who to call if there's an emergency, things like your doctors, your dentists, everything. It's absolutely free. You can download it, share it with anybody and their mother because it's really important because we've seen what happens when somebody doesn't have that basic information. You'll be really upset. And then another one is Clint's YouTube channel is absolutely fantastic. Deals with more on the real estate side and asset protection. He's a genius when it comes to the anonymity and how to set these LLCs up. He's a wizard when it comes to doing the operating agreements and very adept at making things disappear from a liability standpoint so you can sleep at night. And then, of course, join us for any of our free workshops. And if you feel like it, come on out to our live workshop in Texas. Learn more. Just click there. But it's fun. You're going to get to hang out with us and Elliot and everybody else. Yeah. Hopefully it won't be too hot. I won't melt. But the cool part there is you get to hang around other people that are doing what you're doing. And I don't know about you guys, but when I started buying properties, I used to get a little bit of guff. We're over, Clint and I are over 300 properties now. And I remember the first 10. And I remember people were like, well, you're going to be a real estate baron. No, I just want cash flow. Sorry, it's one of those items that I buy for cash flow. And then the more you buy it, the more addicted it gets. And then you just like buying it.
And what are those guys saying now to you?
I don't know. I don't talk to them. That's why you need to elevate your circle, right? Come on out to the event, hang out with a bunch of real estate people. No, there's great people all over the place. Just some people didn't get it. My dad actually never got it, and then he came to me one day and he goes, "You're doing what all like." He had a bunch of guys at Boeing that had done a bunch of real estate deals. He goes, "You're doing that, right?" And I said, "Yeah, that's what I'm doing." He goes, "Oh, they did really, really well." I'm like, "I've been telling you that for like 10 years, Dad." But I'm the kid. All right, questions? If you want to have your question featured, email it on in, and please give us some twisters so that we have some cool stuff to talk about. You can always check us out at andersonadvisors.com. Thank you to Kenny, Jared, Dutch, Ross, Tanya, Amanda, Jeff, Dutch, I already said Dutch, Patty, Troy, Jared, all these guys answering questions. They have answered over 209 questions. There's still 10 outstanding. We will answer those. Boom, boom, boom. They will get done probably within 5 minutes. So this is what I'll say to you. Adu, thank you for joining us for Tax Tuesday. We'll see you in 2 weeks. I'm going to mute myself and turn myself and Elliot off. Thanks for being with us, Elliot.
Thanks for having me.
And we will see you in 2 weeks. If you have a question pending, just hang out. We'll answer it.